How are you?
Hi. Okay. So do you
Yeah,
have
I
like an
wanted to
action
say
point?
something. Yes, yes.
Okay. Okay.
Yeah, I was not part of the session, but then before joining the session, I prioritize working more on publicizing what I do. You understand? Because most times I just do it, not bringing it out to the limelight. You understand? But just recently, I just had I went out, bought books, then I started saying, okay, I will start making content. I'm just going to be drafting down the ideas, you understand? Start writing the ideas, start getting the gadgets little by little, 15% of the salary and all, just trying to get that particular thing right. So I believe that's just one action point at the moment for me, you understand? Content creator. I
Awesome.
want to join them in this space, you understand?
I wish you best of luck. There's space in the sky for everybody. Thank you very much, Jamie. I like how even though you didn't
Yeah,
attend
thank you.
yesterday's session, you still had a lot of things to say that were very, very valid. Thank you. Okay, so we have people here already. We have our first speaker here with us, so we're just going to get right into it. So welcome back, everyone. It is day 2 of the Career Workshop 3.0, and I'm glad you're showing up again, or if you're showing up for the first time, I'm glad you're here because it tells me that you're serious about building a career that lasts and thrives. So yesterday we learned a lot of things, gave us the big picture. We learned so much about how to move forward, how to build visibility, how to grow your network and how to stay authentic in your career. But today we're going deeper. So we're going to have more clarity, more practical insights, more conversations that actually move you forward. So settle in, stay curious, and make day 2 even better than day 1. Make sure you write notes. Make sure even if you're not going to write all the notes, make sure you have action points, at least one or two that you're going to implement right after this class. That's the most important thing I say. You don't have to have everything up in your head, but make sure you have something at least that you're going to act on. And make sure you also have questions. Have as many questions as possible, right? So without further ado, we'll be moving on to the first speaker, and I'll be reading his bio now. Very bad habit I have, not introducing myself. In case you do not know me, my name is Oludo Ainide, and I work with Youth Growth Africa uh, as programs manager. So, as programs manager, right? And Youth Growth Africa is actually the organization that is powering the Career Workshop 3.0, in case you do not know. So, without further ado, let's get into it. So, we have our first speaker in the person of Mr. Al Qasim Uthman. Al-Qasim Uthman, CFA, FCA, FCCA, is the Chief Financial Officer at Kano Electricity Distribution Company, KEDCO, where he leads financial strategy, corporate governance, and operational efficiency for one of Nigeria's largest electricity distribution companies. He holds an MSc in professional accountancy from University of London, alongside multiple distinguished professional designations, Chartered Financial Analyst, CFA, and fellow of both the Institute of Chartered Accountants of Nigeria, ICAN, and the Association of Chartered Certified Accountants, ACCA, UK. This blend of academic and professional credentials underscores his depth in both theory and practice of finance. Al-Qasim began his career in the UK with F.H. Britling and Mysander and Co. Chartered Accountants for working with Deloitte in Bermuda, gaining global exposure in audit and financial services. He later returned to Nigeria, where he served in several leadership roles at the Central Bank of Nigeria, CBN, including securities analyst, forex and fixed income dealer, and senior investment advisor. In 2022, he transitioned to the energy sector, first as a general manager, audit, and later chief financial officer at KEDCO. His work has focused on financial restructuring, operational reforms, and risk management, achieving a measurable impact in revenue growth, cost efficiency, and institutional resilience. Beyond his corporate role, Al-Qasim is passionate about mentoring the next generation of finance professionals and advancing conversations on governance, resilience, and financial sustainability in Africa. Ladies and gentlemen, if your hands are not too busy, with a rousing round of virtual applause, let us please welcome Al Qasim Uthman. You're welcome, sir.
Thank you so much, Ayomide, and it's nice to join you. I've been listening to the conversation. I think you have covered a lot from the day one. and this is day 2. So you guys have really covered a lot. Amide, can you see my screen?
Yes, I can see it.
Okay. So just hold on. Let me just try to. You can see and hear me, yeah?
Yes, sir, we can. Yes.
Okay. Yes. So nice to meet you again, and nice to meet everyone. I've met some few of you, Isiwat, and some people on the call. Yeah. So my name is Alkasim Usman, just like you've said. I'm currently the Chief Finance Officer of the Kano Electricity Distribution Company, and I'm happy to join you and share my experiences and give you some insights. And I'm happy that you said you have a bunch of is it note takers? You said people that take note, yeah. So you just take few notes. Yes, yeah. So you just take few notes as we go along. Okay, I've already said a bit about my bio. So this is me. This is a few of my professional qualifications and places I've worked. Okay, so you have not told me. You have told me who you are, Amide, but who are our audience? Is it graduates, early careers, professionals, or just give me a feel of our audience?
All right. So based on yesterday's insights, most of our audience are students, early career professionals, people that are just curious about improving their careers, mostly early stage to mid stage professionals, but
Okay.
mostly students. Yeah, mostly students and then early stage career professionals. Yeah.
Okay, so I think based on what you have said so far, I think I know a bit of about your expectations. Or do you want to add more? Is there any specific expectations you have from this conversation?
From this conversation, I think one of the biggest expectations is just general insights into what we can do to improve our careers, especially something that's is something that's applicable over a wider range. So it should be something that anybody in any career can apply and improve, even with your added expertise in finance and financial systems. So that's to really help us boost the knowledge base that we have and get us practical about what we need to do to improve our career, sir.
Okay, so do you want to ask questions as we go along or just at the end?
At the end, sir. So we're going to listen throughout your presentation, and I know as soon as the presentation ends, people will have questions.
Okay, so that's fine. So let's just jump into it. So this is going to be our agenda. We had a bit of introduction. I will basically speak about 3 major issues. I'll speak about the difference between traditional finance and behavioral finance. I will also speak about some behavioral biases in finance and investments that actually affect our overall objectives. I will also speak about the investment policy statement, which is something that is crucial for everyone to have, whether you are an institution or an individual. And especially now that you guys are young people, students, early career professionals, it is very key that you have an investment policy statement which will guide your objectives, and also it will bring about your return objectives, things like your risk tolerance. You will know how to rebalance your portfolio as you move along. And you're so happy to have someone speak to you about this. These are things that we learned later in our career. We did have this kind of mentorship, but it is something that I wish I've known earlier. And it is the first thing that, in fact, you need to do, whether you're in finance or anywhere, because at the end of the day, whatever you do, there's a bit of investment. Even if you have your money in fixed savings accounts, or you have POS by the side, or you have a kiosk or a shop that you sell stuff, or like someone said, what do you call that? Or the content creators. It's all about portfolio. So if you look at all the things you own and all the things you have your monies in, It's all about portfolio, and we are all investors, one way or the other. As far as you are working towards making money and building some wealth, you are considered an investor. And it is very crucial. The first thing you need to do is to have an investment policy statement. And it's also good to know that finance, as we know, is moving towards behavioral. So those assumptions that information is perfect, all those mathematical or stringent assumptions of the traditional finance has actually been found not to be true. That people do not behave rational, people behave like humans. And most of the things that move markets or move investment and finance is not actually all those models or theories. They're actually human behavior. So it is very crucial that you note these 3 key items, that is traditional finance and behavioral finance, and the intersection, and also the behavioral biases that actually hinder people from achieving their objectives, and also the need to have an investment policy statement. So let's just talk a little bit about the traditional finance, which I believe most people in finance, that is the kind of study that they are into. But you need to recognize that there is a new field which they are not like discarding the traditional finance, but they are saying that finance is actually behavioral. It's not what we are used to. So let's look at a bit of the differences and how they intersect. So generally, traditional finance, there are 2 distinct approaches to the financial market dynamics. If you look at traditional finance theories, they assume investors are rational. But if you study deep, you'll find out that investors are not really rational. And they make decisions that are influenced by emotions, not necessarily based on objectivity. You know, recently there is a huge sell-off in the stock market. People are selling their stock, mostly the institutional investors and foreign investors. They're afraid that there is a new tax law that is coming next year where they'll be charged 30% on capital gains tax. So people are selling off. But those are emotions. And there is nothing like empirical evidence to show that if the tax law comes into that they will lose their asset and so on. So you find out that people are moved by emotions, not really rational theories or those kind of traditional, I don't know how to put it. But some of you have studied traditional finance, I believe. So those things that they will tell you, humans behave rational, that if you put 2 investments side by side, humans will choose the ones that give you the highest return. But we have seen that people don't usually now conform to the traditional beliefs. So that is why it is good for all of you to start looking at the behavioral finances and see how they affect investments. So let's just look at the core assumption, and so that we can try to differentiate between traditional finance and behavioral finance. In traditional finance, it assumes that investors are rational and they make decisions to maximize their expected wealth. But in behavioral finance, we have seen that psychological factors, emotions, and cognitive biases influence behavior. Cognitive biases simply means that no one has full knowledge of facts that he needs to make investment decisions. People just have limited knowledge, and it is called bounded rationality. So that assumption that investors are rational is not really true, because there is a lot of cognitive limitations, because you don't have all the facts. And there are emotions that drive people, things like greed, things like fear, and so on and so forth. So you find out that people don't really conform to that traditional approaches. So in terms of investor behavior, traditional finance are saying that investors are logical, they process all information and have self-control. But it has been found that investors are not logical. There's what they call bounded rationality. Like I've said, people have limited knowledge and people act irrational at times. And like I said, people are influenced by fear, greed, and other biases. And in fact, if you study the stock market, you can see all these bubbles and crashes are not led by fundamentals. Like people will just see people selling stock or buying certain things or going into certain ventures, and they will just follow them, what they call herd mentality. So you find out that all that thing that we say in finance, that people are logical, process all information, is not really true. That there's a lot of bounded rationality in information, and people are very irrational. And that is the behavioral finance side. So let's look at the market view. Traditional finance, they believe market is efficient, where asset prices are fully reflect all available information, but that's not really true. Like I said, if you look at all these bubbles and crashes, there's a lot of irrational emotional behavior in it. And that is why this study of behavioral finance has gone so far. And in fact, it explains a lot of human behavior, human investment, finance beyond the traditional finance.
So sorry to interrupt you, sir.
Sorry?
I don't know if, so sorry to interrupt you, sir. Your slide isn't moving. We can't see your talking point.
Where are you now? You're where?
The slide is still on the first page.
Oh, wow. And I've been moving. So do we have someone share them?
Yeah, it's moving now.
Oh.
I don't know if it should be possible to get the slides after the...
Yes, so you were here?
Yeah, we're just in number one.
Oh, okay.
While you were speaking.
So let me just rush through. So like I said, I moved to second, where I said this is just a breakdown. You have already spoke about my bio. So this is just some of my qualifications and places I've worked. Then I moved to the introduction page, where I got to know who you are, mostly early careers, young professionals and students. And I also asked about your expectations and the questions format. Is this moving now?
Yes, it's moving now.
Okay, and can you hear me? Am I audible enough?
Yes, we can hear you. You're audible enough,
okay.
Sir.
Yes. So then I went to the agenda, where I said, of course, we have introduced ourselves. Then I said, basically, we'll look at three key areas. We'll try to look at traditional finance and behavioral finance side by side. We'll look at behavioral biases in finance and investment, and also the investment policy statement, which is, even if you don't take anything from our conversation, just know that you need an investment policy statement early in your career or in your life, so that it guides whatever you do in terms of investment, in terms of your goals and objectives. And it is something that you revise yearly, so that you see how you're doing. An investment policy statement is actually there to guide against your biases. You understand? Because if you don't have something that guides what you're doing, those biases that you have started speaking about will come into play, and you will easily lose track. So I moved to this page, where I'm sure we have team traditional finance and team behavioral finance. So which one are you, Ayomide? You must choose one. Then Isiwat will choose one. Are you traditional finance or behavioral?
Behavioral finance. I'm very second.
Are you just moving now, or you have always moved to behavioral finance?
I've always moved to behavioral finance.
Okay, that's fine. Okay, so this is just an overview of the behavioral finance and traditional finance, just a bit of a summary of what it's all about. And we said, though we are not jettisoning the traditional finance, it is something that it has to go side by side. It is difficult because it all has different understanding of finance, but we believe that if you bring them together, we will be better off in finance and also investment. Then we started looking at some of the principles and see how they differ from the traditional finance point of view and also behavioral finance. We said In traditional finance, it is assumed that investors are rational and make decisions to maximize expected wealth. But over time, we have seen that that is not really true, that there's a lot of psychological factors that come into play in finance and also investment. There's a lot of emotions that people use when they're deciding how to invest or how to treat their money. And there's also cognitive biases, which means there is limitations in also the knowledge. We also looked about, we spoke about investor behavior, where we saw that traditional finance believe everybody is logical, process all information, and have self-control. Self-control means, for example, if you say, I'm going to, out of my 100 naira, for example, I'm going to spend 50 naira and invest 50 naira, you will stick to it. But do we have that self-control? We don't. We're all humans, and we are irrational, and we have that bounded rationality, which means we have limited information on even the investment products that are there. If you tell somebody that maybe someone goes to bank A and tell you that the fixed deposit there is giving him 5%, but you can be sure that he did not go to the 30 banks or more in Nigeria to find out whether they have higher interest rate, or also even the ones that he could have invested with abroad. So that is why we say there is bounded rationality. So that assumption that people are logical and process all information is actually not true. Nobody has all the information. So you just use the information that you have at your disposal, which is very little. We look at the ways both traditional finance and behavioral finance look at market view. We said the traditional finance keep on speaking about efficient markets where prices, asset prices fully reflect all available information. Do you know, if you follow the Forex market, when Trump announced that Nigeria has been designated a country of concern, our currency moved a bit, because there is a new information that came in, so it will be priced in the asset. But traditional finance are saying that even the information, even the historical information and the future information has been priced in all the assets, but that's not really true. You find out that an information will come out today and it will drastically affect an asset class. So that is why that assumption that asset prices fully reflect all available information is quite not true. Let me not say not true, but behavioral finance have different views by saying that there's a lot of irrational behavior that affects finance and investment beyond assumptions of perfect markets, efficient market hypothesis, and also rationality. So the key factors of traditional finance, is all about mathematical calculation, data analysis, and market fundamentals. But like I said, if you study the stock market, you'll find out that what drives the stock market in particular is not even all this mathematical calculation or data analysis. It's all about emotions, hard mentality, where people will just follow what everyone is investing in or doing. We have things like loss aversion, where you see people are so averse to making losses that they will keep on changing the kind of things they invest in, and that will make them even take more losses. We have things like overconfidence bias. There are people that are so overconfident in themselves, they feel maybe because they have gotten some deals right, that they believe that they are above average in knowledge and thinking. So they go into ventures solely thinking that their own abilities will see them through. So not only relying on mathematical calculations, but they feel their knowledge is above average. So things like that. So behavioral finance believe that these emotions are actually what drives investment and also market beyond the mathematical calculations that we have been studying. So in terms of decision making, traditional finance believe that investor behavior can be predicted based on logical, calculable decisions. But in behavioral finance, we've seen that that is not the case. There's a lot of rational expectation, emotions that lead people to make a lot of errors. So I think we are almost in the last slide of this section. So in practical application, traditional finance works in frameworks like asset allocation and portfolio optimization, because those ones are purely mathematical theories. But in behavioral finance, is used by professionals now to even help clients identify and overcome biases, because it is now accepted that we all have our biases. So what is now being done is to assist people in actually overcoming those biases. And in fact, even if you meet an investment professional now, the first thing he will do, of course, is your investment policy statement, but he will also get to know you. Like, are you a kind of person who is risk averse? Because there are some people that they cannot take losses based on their emotions. If they lose 1 naira, they will not sleep. And there are some people that their risk tolerance is a bit higher. So before you even recommend anything to anybody, because there is no one size fits all, and that is why when Isiwa told me to give a talk on investment, I said there is no one size fits all now. We are all different. So you have to, just like the doctor diagnoses patients, finance professionals now to diagnose you to find out the kind of biases you have, and also your objectives and what you're even trying to achieve, and then try to prepare an investment policy statement and also asset allocation that fits you as an individual. So I'm not someone that will come and give you blanket advice on what to do, because we're all different. So because of the study of behavioral finance, if I sit with each one of you, what I will recommend to you will be different from the next person. And you will hardly see 2 people that will have the same investment policy statement, because we are all different. We have our biases and so on and so forth. So this is the last slide before we finish this section, where in traditional finance, they will view things like bubble and .com as inconsistent with efficient market hypotheses. Behavioral finance will look at them, such phenomenon like the bubbles and crashes, due to the emotions. So we'll look at the emotions and find out that it's actually the emotions, things like herd mentality, where we are all investing because we see everybody invested in Bitcoin, for example, or everybody is doing one thing or the other. So not based on fundamentals, and things like overconfidence and so on and so forth. So these are the things that actually lead to crashes, and these are the things that actually it's behind people's choices of investment, not actually the traditional finance, the calculations and so on. So it's the behavioral finance. So this is just the bottom line. It's more like a summary where we say the margin of conventional and behavioral finance could improve our understanding of financial markets and investment choices. If you combine the two, they all have their advantages. We can create a more accurate models for investor behavior and have more efficient financial goods and services. But of course, integrating them will be difficult because the methodologies are different. So this is just a bit about traditional finance and behavioral finance. And I believe some of you that have not heard of behavioral finance may try to just do some study and then see how they intersect and how they're different and how they are different. So let's look at some behavioral biases in finance. Behavioral finance is a subfield of economics. It proposes that psychological influences and biases affect the financial behaviors of investors and financial practitioners. Influences and biases can explain all types of financial and investment anomalies. Like I said, if you follow the markets, if you look at even global events, you find out that they are actually being led by emotions, not actually based on facts. If you see the US probably, or maybe trying to invade another country, if you look at the core of it, is it actually based on fundamentals, or is it based on facts, or is it just emotions? So even if you follow one event, you find out that some things are actually emotions. There's nothing like they cannot back it out with facts or empirical evidences, and that is why even in finance and investment, there's a lot of biases that is playing, but we don't know. We feel everything it's as it should be. So let's look at some concepts, some behavioral concepts, then we move on. So there is a concept called loss aversion bias. This one, most people have it. It occurs when investors place greater weight on the concern for losses than the pleasure from market gains. So the effect is that you find out that some investors try to avoid losses altogether, even if the investment risk is acceptable. So this is a very, very big and serious bias that affects people. So you have to look at yourself whether you have this loss aversion bias. And if you go to the internet, there's a lot of studies that will even make you identify your biases. And I think it's good you do it so that you think of mitigants. I won't tell you the mitigant because it will drag our conversations, but for every bias that you see, there are mitigants. So let me leave some things for you to research. There's also this, what we call familiarity bias, where you find out that people try to go into stuff that they're familiar with. You know, now everybody is a content creator, so you find out that because it is what is familiar in this generation, people, if you ask them, they will tell you, I would also want to do something that is familiar. So it's a bias that has serious effects. And what you end up doing is that you are not well diversified across multiple sectors because you just go with what is familiar and what is available. And of course, we have said we all have our bounded rationality, so we don't have all the information. We just have very little. And that is where the familiarity bias is. So think of the mitigants. One mitigant is actually having your investment policy statement, so you don't follow trend or what is familiar. There's also mental accounting bias. Let me tell you this bias that led Nigeria as a country to start this treasury single account. So mental accounting means people place money in different buckets and they don't see them as one. So you see a ministry or a government agency, they have one account that they designate for project A. Maybe it has 100 billion, for example, but that project is to start in 2 years' time. But they have another account where they will need to run the organization, and that one is zero. So because they have put the monies in different baskets, mental accounting, they will go and actually borrow money with high interest rates just to sort out current issues, but they have another bucket that has some money. So what the treasury single account did is that bring all the monies together. So if you bring all the money together, you find out that you don't even need to borrow, for example, because you have enough money. It's just that because you mentally allocated them differently, you think you don't have money. So it's a bias that will lead people to have irrational spending or poor investment choices. Maybe you have projects that you need to develop or bills that you need to settle, but you have already mentally seen your current account as an account that you can just use it to spend and enjoy. So if you have maybe 1 million in your account, because you have mentally told yourself that any money in my account is to buy shawarma and eat suya, but because you have forgotten that you are looking at your funds in different buckets, you will not optimize your funds. So money is fungible. You should bring all of them together, and that is why you should have this investment policy statement where you see everything globally. You have your asset allocation and see things as a portfolio, not just differently. Because even in school, you see people putting money in different accounts and thinking therefore. So it's a big bias that you should also look at the mitigants. We have spoken about the herd mentality, where people tend to follow what everyone is doing. And that is even the cause of a lot of bubbles and crashes, because it is not based on any fundamental, but based on just what others are doing. Just like herd means cows. You know, cows just follow one. Wherever the guy is going, the one that leads the cow, everybody will just follow the same direction. Nobody sits back and do some studies to find out whether it is actually the way to go. We have spoken about the overconfidence bias as well, which also lead people to take excessive risks and ignore warning signs because they feel their knowledge is above average and they may trade too frequently. And we have seen where people lose a lot of money in this because they have this bias. So you should look at the biases you have and try to think of the mitigants. So the bottom line of this behavioral finance is that it's an area of economics that fuses whatever is traditional or conventional with psychology. It ascribes the often irrational behavior of individuals when faced with financial decisions to a variety of biases. So individuals unaware of these underlying biases at work can be making bad decisions. So if you study this area of finance, it's essential to anyone who wants to master the art of trading and finance. And why I'm saying this, because I've spoken to Isiwa. She said this conversation is for long term. So I'm not for short term. So all this is I'm telling you is for your long term. I don't have the answers for short term. If you want short term money or short term investment, but I'm telling you things that will actually last you in lifetime, 30 years, 50 years down the line. So let's go to the investment policy statements and then we'll wrap up. So like I've introduced, investment policy statement is simply a formal document that acts as a business plan for an investment portfolio, more like a roadmap for investment decisions. So it guides investors and financial managers towards achieving specific financial goals. It outlines your objectives. So before you even start anything, even if it's your career, it's your business, you need to even sit down and ask yourself, what are my objectives? And you should have the short term, the medium term, and the long term. So based on your objectives, your objectives will lead you to the kind of investment or the kind of venture that you should go in. And like I said, we all have different risk tolerance. Some people, they cannot afford losing money, and some people are more tolerant in terms of losses. So they look at the upside and accept the downside. That is why even in the pension industry now, there are buckets. I think there are like 4 classes to take care of people with different risk tolerance. There are people that just want safety, just preserve my capital. But of course, the more safe you play, the less you earn. So there is a bucket for them. And there is also the more aggressive ones. So based on the risk tolerance, even the kind of assets, the kind of investments that the buckets go into, it's different. So someone that is very risk tolerant, you will not see equities in his portfolio. You may see things like bonds, which are safe risks and zero risk and so on and so forth. But people that want higher return, you see them having more risky asset classes. So investment policy statement is something that we all need. I have mine as well. All organizations have, and all businessmen, big people now have it. So it will help us as we go on, and it will also help us to see our investment constraints and so on and so forth. So let's look at the kind of things that you have in an investment policy statement, or the purpose of investment policy statement is to provide discipline. It helps you avoid emotional or impulsive decisions, particularly during market fluctuations. So someone that has this investment policy statement, for example, and you are for the long term, let's say 5 years, you have an objective to achieve a certain return in 5 years, you will not be moved by the recent sell-off in the capital markets due to the capital gains tax that is coming next year, because you know that stock markets goes up and down. So you will not be moved by all these short-term fluctuations because you are guided by your policy statement and your objectives. It also makes you set as your expectations. So for example, if you have an investment advisor or financial advisor, it is better you sit down with them and set your goals so that there is no ambiguity, there is no, I didn't tell you to do this, you did this. So it sets expectations. It also ensures consistency. Yeah, so let's move on. Provide discipline, set expectations, ensures consistency. It's also a form of protection, especially for the institutional investors, because it is well documented. And you know, people like to blame. So if we have an investment policy statement, we agreed with you that we are going in a certain direction and it didn't work out well, we have document that protects everybody. It also allows you measure your performance against benchmark. So these are just some key components that you find out in a typical IPS. Of course, it will have a scope and purpose. It will have roles and responsibility. It will have your investment objectives. It will have your risk tolerance. Like I said, we all have different risk tolerance. So you need to actually determine your risk tolerance very early. Then it will determine the kind of assets that you go into. And also constraints. You may decide to go in a certain way, but there are constraints. Some may be liquidity needs. Maybe you don't even have the money that you want to go and build refineries, because some people's objectives are that big. I speak to people, they will tell you that they want to start an airline, but they don't have the money. So your objective is noted, but currently you have constraints, maybe liquidity, maybe there are tax considerations. There are some ventures if you go into, it is heavily taxed, so you have to look at the tax considerations. Some things are not legal, some things there are no regulatory backings, and some things are not even ethical. So if you, some people are also guided by their religious beliefs. So some things you cannot even tell them to go into. You won't tell a Muslim to maybe start a brewery or things like that. So there's a lot of considerations that will serve as constraints to whatever you think you want to go into. So all these are some of the typical sections in an IPS. So there's also what we call a rebalancing policy, because you have already set your objectives. This is where I'm going to, but it is subject to rebalance. It means at the end of the year, you will sit down and see whether your portfolio mix will help you achieve your objectives. If not, you rebalance. For example, you have more in one asset class, but that asset class is not doing well. Another asset class that you have underweight is doing better. So it gives you opportunity to rebalance your portfolio, because like I said, whatever you have is a portfolio. If you have a piece of land, if you have money in the bank, if you have shop, they are all your portfolio. So it is good to sit down once in a while to rebalance. Maybe you have bought too many lands that it is taking so much of your portfolio, but it's not even giving you liquidity. So you may decide to rebalance, sell them off, and move them to another asset class. So it also, like I said, it's also so there's a section for also performance monitoring and review and update. So it's very, very, very crucial. So let's summarize, because I said it's going to be short. These are just high level. You can decide to look up this concept more on yourself. Then maybe if you have your IPS, if you have identified your biases, we can come and have another talk. Then it will be deeper. So to me, or this is my own point of view, if you want to cultivate financial intelligence for long-term success beyond the paycheck, you need to understand the intersection of traditional and behavioral finance. You need to determine your biases that may affect your finances and investment, because if you even sit down and look around now, you find out that a lot of people, what is holding them back are those biases, those psychological things, those emotions. Not even, not even the traditional theories that we know, the traditional finance theories. It's just purely emotions. And then, like I said, try to get your investment policy statement. Some of us are not finance people, but it is so easy. If you even go to the internet and read about it, you'll find out that you can prepare your own investment policy statement, really. Or you can get someone in finance or a finance professional to help you prepare one. But at this level, you can just prepare a simple one. Mentally, you have an idea of your objectives, you know your risk tolerance, you have identified your biases, and hopefully you know how to overcome them. You also know the kind of asset classes you need to go into. So you keep on revisiting them, maybe periodically, quarterly, monthly, yearly, and see how well you're doing. So this is just the end. It's high level, like I said. So people are not fine in finance or investment or accounts, but I believe even if you didn't take anything out of this conversation, just know that traditional finance, it's moving to behavioral finance now. People are using behavioral finance or behaviors of humans to actually explain finance and investment. We all have biases, and those biases actually tend to hold people back a lot. So we all can do a check of ourselves, just like the doctor diagnoses patients. You can actually, there are tests you can take to find out the biases you have. Then, like I said, it's good for you to have your investment policy statements, even as individuals, to guide your investments, even your career, because it's all encompassing. When you have an investment policy statement, you can have your goals broken into the short term, the medium term, and the long term. So thank you very much for listening. Let me have some questions.
All right, thank you very much, sir. Thank you very much. I was following all through. Can we give Mr. Al-Qasim a hearty round of applause for such a wonderful presentation? Thank you very much, sir. I appreciate your depth of experience and wealth of knowledge. So, like he said, now would be the right time to start asking your questions if you have any. So, does anybody have questions?
I just hope I made sense. I hope I made sense.
Yes, sir. Yes, sir. But I can't speak for myself alone. Okay. So yeah. We have Fauzia. Anybody else? Just Fauzia. All right. Maybe when Fauzia asks questions, we spark other people to also ask questions. So let's have you, Fauzia.
You can ask it as simple as you can. Don't even make it any technical. Just ask as layman as you think you can.
Okay. Thank you, sir. And thank you so much, sir, for this explanation. It was really detailed. In fact, it was like I was seeing myself as a person handling financial issues. So my question right now is, please give an example of a financial statement, a financial policy statement, please.
Okay, so a financial policy statement is actually a document. It's actually like now, if you meet, people, there is all these financial advisors. There's all these asset managers. You know them, yeah? You know there are people like that. I'm just asking you, if you know we have financial advisors, you have financial planners, you have asset managers, and so on and so forth, especially in the investment world. And you also hear people, all this meeting, investment bankers, and so on and so forth. So when you go and meet a finance professional now that you want to invest, that you need recommendations, they will 100% not tell you anything. They will first of all sit you down and diagnose you, and that will lead them to have an investment policy statement that is tailored to you. Like I said, we all have different objectives. We all have short-term objectives. So some people will come to you with a very short-term objective, maybe 1 year. Some 5 year. I want to build a house. I want to buy a car. I want to go for masters. I want to pay for rent. All these are objectives. So somebody will meet you that he's looking to save for 6 months to pay rent. You will not tell him to go and invest in certain asset classes. So first of all, you have established his objectives, what he needs to even achieve. Then secondly, you will try to know his risk tolerance. Like I said, some people are very risk averse. They don't want any risks. They just want to preserve their capital and build on it if possible. If not, keep my capital. Some people have very bullish expectations, and they're ready to, for example, go into the stock market. So the second item is that I know your objective. Let me also know your risk tolerance. And I'm also, and I'm actually writing this down and documenting it. I know your objectives, I know your risk tolerance. Then I also know your constraints. If you come and tell me now that you want to start a bank, I will note it down, but I will ask you whether you have the funds. If you don't have the funds, that's a constraint. So you we are building it stage by stage. I know your objectives, I know your risk tolerance. So now I'll start advising you based on what you're telling me, because I already know you have constraints, that these your objectives may need to be altered because these constraints will not allow you achieve them. So you have things based on that. Again, we'll look at the kind of asset that will help you achieve your objectives, and then we'll have rebalancing policy where we'll decide the periodic times that we'll sit down to rebalance. So it's just a statement. I know it's not common out there where you see investment policy statement. They're mostly in investment banks, financial advisors. But I'm just saying it's something that you can also have yourself. And it's just easy if you even go to the internet and look at a typical investment policy statement. You just look at all the sections and you can develop one for yourself. So I don't know how to tell you an example, but I know it's a document that exists. And you can have one for yourself as well.
Okay, thank you so much, sir. I understand better now. So basically, what you said is that we can diagnose ourselves, find our spending habits, what we can invest in that is good for us, that will not have heart attack, and then we now, based on the study on ourselves, we now invest in something that can help our funds to grow towards our targets.
Yes, so you start with your objectives. What do you want to achieve? Do you know what you want to achieve in the short term, medium term, and long term? So that should be the starting point. So when you know your objective, then it's also good to set your risk tolerance. And I'm sure you know people that cannot stand losses. If they lose 1,000, they can even cry. There are people that if they lose 10,000, they just say, so be it, I will make it the next. So emotions, biases, you cannot put them away as you move towards investment or in trying to achieve your objectives. So that's why I said there are people that are they don't want any disruption. If they tell you your objective, these ones, you can even say, you know what, just go into civil service or get a job 9 to 5, don't even do anything. There are some people, if I speak to you, I'll tell you, you know what, don't even do any investment. The way I see you, your biases, your risk tolerance, please just get an employment and don't go anywhere. But there are people that if you speak to them because of their objective, because of their risk tolerance, you can say, you know what, don't even take any job. Just from day one, be an entrepreneur. So that's what I'm saying. The first thing you need to even do is, what is your objective? And what is your risk tolerance? And what are your biases? And what are your constraints? And all these things are contained in an investment policy statement. That's why I said it's good for. So this, my talk is actually a prescription for you to do more study of behavioral finance, biases, and investment policy statement. I don't have all the answers now. We cannot exhaust everything here, but I'm just prompting you to do more study so that you can get your investment policy statement.
Okay, I understand. So thank you so much, sir.
All right, thank you very much, sir. Does anybody else have any questions? Any more questions? Any more questions? All right, so I think that's all the questions people have. This, as you said, it's quite high level stuff. I hope we're able to grab one or two things.
So this is high level.
I think
I thought I broke it down. Oh my goodness, I'm sorry.
Yes, you broke it down, sir. But I imagine that other people might have had a bit of time or a bit more work trying to digest it. So yeah, this is another question.
Yes, I do. So I want to ask that what are examples of things that people can invest in monetarily? most times when I hear investment, I think I remember I wanted to invest in agriculture one time, and they told me that in order to do consultation, I have to pay 20 something K. I was like, 20 something what? That's consultation, not even the land, not even the other things. So I want to ask that, for us like this, that we're just starting, and we just want to put money in something with hope that it can grow in some years. What investment options do you think we can venture into?
Okay, so like I said, I will not tell you any investment option if I don't know your objectives and your risk tolerance and your biases. So all this I'm telling you is that don't just jump into investment without trying to set your objective. So the first thing you need to do is, what is even my objectives? I don't know if you get me. Know your objectives, know your risk tolerance, know your constraints, and based on that, it will even start telling you the kind of asset classes you can go into. But don't just start going, okay, because everyone is doing agriculture, I'll go into agriculture. Everyone is now an influencer, I'll become an influencer. So that is hard mentality. So you will actually exhibit one of the biases that we have spoken about, which is hard mentality. So just take a breathe in, breathe out, sit down, even if it's one weekend, take your book and start writing. Even if it is, let me go back to these key components. Just write scope and purpose, write your objectives, and the roles and responsibilities of people that can help you achieve those your objectives. Try to set your risk tolerance. Based on that, you can have the kind of asset classes you can even go into, and also what are your constraints, So I know it's hard for you hearing it for the first time, but try not to go into investments without even setting an objective. And that objective, is it short term, is it medium term, is it long term? So it is your objective that should lead you to the kind of things you invest. And also your tolerance to risk and your biases. If you identify them, you can overcome them.
Okay.
Is that okay?
Yes.
Yeah.
So another question, my last question. If I find my biases, if I'm able to generate this policy for myself, now can I now proceed? The thing is, we have so many people that claim to be investors or claim to help investors to raise their capital, but they are scam. They are scam. So when we now have this policy, when we have this personal policy, and we know our scope, we know our objective, we know what we want to do, we know our biases already. How do we now proceed from there? Who do we now reach out to? Like, okay, this is me, I want to invest, this is who I am, this is what I can do. How do I now proceed? What business should I invest my money in?
You're actually forcing me to tell you where to invest your money. Okay, you know what? Is this going to be a recording seminar? Are you guys together? You have a group association, so that we can take one person or two people to do their investment policy statement, so we can share. The AMCO, is it something that you're just meeting for the first time, or is it association or something, so that we take somebody and practicalize their investment policy and see?
Yes, yes, I think we can do that. This is the 3rd edition, so there's going to be a 4th edition as well. So I think we can do that. Thank you very much.
Okay, so this lady will use that to make her investment policy statement. Then she will see a lot. Based on that, it will even lead her to the kind of things she wants to invest, and naturally, it will be there for her. And so we'll make time to do one for her. So let's fix time. I will do one for her. So it's like you are coming to see a doctor. We are going to diagnose you. We'll see.
Thank you so much, sir.
Thank you. I'm not happy.
Thank you very much, sir.
I feel this is so elementary. I'm sorry. I don't know how to bring it any lower. So are we all finance students, accounting, or a mixture of fields?
Make sure of it, sir.
Okay, I'm so sorry. Some people may find it painful. So if there's, so over to you, Ayo.
Yeah, thank you very much, sir. Okay, so I think nobody has any more questions, but honestly, I think we just want to display the power of just showing up, honestly, because for us, I just want ourselves a proper financial analysis, right, from one of the top minds, the best to do it. So I remember yesterday when the second speaker was speaking to us and he said one of the three most important things you need to position yourself are your skill, your visibility, and your network. Well, your visibility is very, very important. Nobody's going to care about you or know about anything you're doing or what you have to offer if you're not making yourself visible out there. And I think I mentioned yesterday as well that one of the first things I make sure I do wherever I find myself is to make my presence known. I might not be able to connect with people one-on-one, but what I can do, leveraging my skill in like wide range communication, like being able to speak to the crowd, is something I always leverage every time just to make myself visible. Put yourself, buy mental real estate in the minds of people. I think it's very important. So thank you very much, sir. Once again, really appreciate you. So, Imo, I don't know if you have a question because I see your hand up. Imo Wealth.
Yes, I do have a question.
Oh, all right. Sorry. Please do ask.
Okay. Thank you very much, sir, for the session. It was a very nice one. But I want to ask you on risk tolerance, since you've been talking on risk tolerance. So, okay, let me use myself as an example. For someone like me, I know right now that my risk tolerance will be very low. Is there a way it can be improved? Like I can increase it? What are the measures to take? That's my first question. And then my second question, you were talking about stock market and how now in Nigeria, people are like selling off their stocks just because they heard that there'll be a 30% tax on it. So my question is this now: when a situation like that come up, what would be your advice for investors, like so that they will not be scared and start selling off their stocks? Thank you.
Okay, thank you very much. So, like I said, you know, your investment should be led by your objectives. You know, and some objectives are long term, some are short term. Sorry. So you find out that the kind of objectives, and based on your objective, you know you have asset allocations, portfolio management, and so on and so forth. So for me, the kind of asset class that I will assign maybe equities are long-term and long-term objectives. And if you study the way the stock market works, it's zigzag now. It goes up and down and it never stops. But in the long term, it will find its balance. So because I have my objectives, I have my investment policy statement, I know I'm holding my stock for long term to achieve a long-term objective, I will not be worried because this thing is like the business cycle, like it goes up and down, you know? So it will come down, but of course it will go up again. Maybe when the tax come in, that fear they had is not there or is not supported by fundamentals. You see them coming back again, or another news comes in that will make them come back. So you see people going in and out. But because you are there for the long term to achieve your objective that you have already defined, you won't be moved by the short-term fluctuations, which is mostly led by people's emotions, not because those equities they are holding are not doing well or the companies are in trouble. I don't know if you get me. So most likely those companies they are holding, the stocks, the MTN, the Dangote are doing well, but because it is emotion that is leading them, that is why they are selling. But if you know your objectives, you are for long term, then you won't bother. And that is why it is good to know your objectives and know the kind of investment you go into. But if it's for a short-term investment, you put your money there, maybe you want to pay your rent, you know, you will be quick to remove it. So a finance advisor will not even advise you to put your investment in a volatile asset class because your objective is short-term. Then you talk about risk tolerance. I think this risk tolerance, we are all but we all have our emotions, even though it improves with time. But I think it has to do with education. Just like I said, there is this bounded rationality because, you know what I mean, there's a lot of fear. So the more education you have and the more you understand products, your risk tolerance tends to be higher. And of course, the more your worth is increasing, then you can afford to take some risks. So somebody who is worth 1 million and somebody who is worth maybe 100 million, their risk tolerance may be different. And of course, you are younger, you're just starting your career, you are more at risk. So you feel, you know what I mean, you have less room to wriggle or to recover. So I think with education, with getting to know more about finance and investment, and also as you go along your career and life, where you start getting more wealth and assets, your risk tolerance will improve. But for now, is to have more education around the kind of things you want to invest. Because some of the fears you have may not even be justified. So if you have more education, you find out that it's even nothing. So your risk tolerance may increase on that. Thank you.
Okay, sir. Understood, sir. Thank you, sir.
Okay, does anybody else have questions? I'm scrolling to see. Okay, I don't think anybody has any more questions. Thank you very much once again, sir. We appreciate your
So thank you.
wealth of knowledge and experience.
So thank you. And I'm always here. You can reach me anytime. And I will also, the lady that will do the investment policy statements, so you should also get in touch so that we can do a live one, then she can share with you guys. Thank you.
Okay, Caleb.
Thank you very much.
Thank you very much, sir. Caleb, did you want to say something?
Yeah, I wanted to say something before Mr. Al-Kasim leaves. He has left, I think.
No, I'm here. I just stopped sharing.
So I wanted to say thank you very much. The session was technical, but not technical at the same time, because I could really, I got it. I really got all of the things that you were talking about, particularly with the fact that you also try to relate it to, everyday life, using some scenarios that I think really made it make sense. So I wanted to say thank you so much for the wonderful session. I want to take the opportunity to, you get opportunities most times once. I know that this session is a session that is still going to be very, very useful for a lot of young people. Maybe not in this kind of setting, because I think that this setting probably will not allow us to really go in depth with it, like you also had mentioned, because I know that there are still a lot of sides to it, and I know that typically we should get a lot of questions that should come to you. So I just want to take this opportunity to say that we're potentially going to be reaching out again to you sometime very soon, so that we can then possibly see how to create an avenue to then really go deep into this, and hopefully that will help a lot of young people, like everybody on this call, and maybe even more people as well. But I want to take this opportunity to say thank you so much. I particularly learned a lot from I was working on something, I had to stop it so that I pay my attention to this. So thank you so much for this wonderful session. We're definitely going to be in touch, and really we're grateful for your time. Thank you.
So thank you very much, and I'm here anytime you need me. So thank you.
Yes, sir. So for everyone else, I think as much as possible, I think what this really calls us to do is to be a bit more conscious about financial education as a whole. It just should challenge our inclusivity and our curiosity in learning more about finance and trying to do more research on our own. At least that's one thing I don't know if, okay, when she was speaking about behavioral finances, or behavioral finance. I thought back to this dude. I was watching a video recently, and I thought back to this dude called, I'm trying to find his name, William Leeson, that sunk an entire bank, Barings Bank, in 1995, because he kept making all of these crazy investments. And the funny thing is that he was very confident that he was going to make all the money he had been investing back. He made it once and thought he could make it again, but he sank the bank into so much debt. And it's also psychologically motivated in the sense that nobody did anything to question him. The people that were his ogas at the headquarters, nobody did anything to question him. People around him did not seem to question him. The news, the media, nobody knew anything about it till he sung the entire bank. So I think for a very long time, I've been really, really studying how finance can be very, finance, economics, marketing can be very much psychologically intertwined. So thank you very much, sir, again, for that word of experience. I think what I would recommend is some books. For example, the one I have here with me right now is Think Smart, Act Smart, right? Avoiding business mistakes that even intelligent people make. I think this was the one thing that opened my mind to how in business a lot of people move very irrationally. A lot of people move very irrationally. So if you like to understand that particular part of it, I think financial education might be a bit more technical. You might have to do some more research on your own doing that. But if you really want to understand to an extent the psychological part of finances and how people can make mistakes, especially the mistakes part, I think you should read Think Smart, Act Smart by Jim Nightingale. I think psychology of money and psychology of work are also good options to understand how psychology influences wealth and finances. So we still have a bit of time on our hands. So we're just going to do a quick game just to get ourselves fired up for the next session because we still have one more speaker today. Right. So yesterday, I know a lot of people, I don't know how many people were yesterday, but yesterday we were playing this game where we're going to guess people's career by just using 2 or 3 emojis. So this time around, I'm just going to ask like 1 or 2 people to volunteer. And here's what I want you to do. I want you to just tell me 3 clues about what you do, right? And then people will guess. Just 3 clues about what you do. For example, it can be I work with algorithms. I can make your ad go viral. I live on LinkedIn. You can probably start to guess what job that is. So just some creative exercise to really understand the parts of our jobs that most people don't see. So I'm looking for volunteers. Does anybody want to volunteer? Or would you like me to just take it, just throw out random ones and everybody can try to guess? Okay, hi, Fauzia. Let us guess your job.
Okay, my job is, so I should just say words.
Yeah, you just tell us like 3 things that we can use to guess about your job or your career. Just 3 clues. It doesn't have to be very explicit, right?
Okay.
Just something that can make us guess.
Okay. Pen. No. Pen. Yes, pen. Eraser and paper.
Pen, eraser, and paper. Okay, so do we have any guesses for pen? Okay, Favor. Do you want to try to guess what Fauzia does? Pen, eraser, and paper, right? Teacher. Okay, Fauzia, are you a teacher?
No.
I don't know. That's quite, it's quite vague though. You could be a teacher, you could be a student.
Well, I'm a teacher, but that's not what I'm talking about, and that's not the profession I'm describing.
Okay. So does anybody still want to guess what Fauzia's job is? Okay, so Favor says artist.
Okay, yes, artist. What kind of artist?
Okay, Favor, give us a bit more, a little bit of details.
Do I draw? No.
An artist that teaches
No.
others?
No.
Or sketch? No. Okay, let's have more guesses, guys. Can you drop the clues again so people can remember? I'll drop it in the chat so people can remember.
Okay, pen, eraser, and paper. No, I'm not a writer.
Okay, architect. Someone said architect.
No, I'm not.
An artist that teaches others.
Uh-uh.
Okay, so Let's. Nobody else wants to guess.
Visual artist. No.
Favor says visual artist. Pen, eraser, and paper. It's not even pencil, it's pen. Pen. I can get pen and paper, but I don't get why eraser is there because eraser can't even erase pen. Unless it's one of those special pens where you can have an eraser.
So it's a special pen.
It's a special pen. All profession or career is a special pen. Please, you should not leave me hanging dry here, please. Is there anybody else? Does anybody else have any guesses? What career is a special pen, please? I don't even know if I only buy pens for aesthetic.
Okay, more clues. Should I say more clues?
Hey, you can tell us more clues, please.
Okay, the type of pen is a brush pen.
A brush pen.
Yes, it's called a brush pen.
A brush pen, okay. Man, I'm cheating now. I want to go and check Google. What's a brush pen? Okay. Oh, all these kinds of pen. Are you a calligrapher?
Yes.
Sharp, Joe. Forget. I read this PS. Forget. Oh, that's very interesting, though. Can you tell us a bit about it? Like, I'm like, this is the first time I'm seeing someone that is someone that's like into calligraphy. Can you tell me about how you got into it? I'm very curious.
How did I get into calligraphy? Honestly, I just found I'm a teacher and I'm very well known for beautiful handwriting, for my beautiful handwriting. Like people see my beautiful handwriting and they're like, wow. The kids in my class go for competitions and win the competitions. So someone just put it out to me that okay, I noticed I found this thing online. Do you want to try it? Calligraphy. I'm like, calligraphy. It's going to be simple. But then when I got there, when I started, it was really, humbling. It was humbling. And I found joy in it. And so I just started. That's how I just started.
That's very, very nice. Because I recommend immediately I saw the brush pen, I was like, what is the brush pen? And then immediately I saw it, I recognized that okay, this thing they usually use for because I see a lot of YouTube channels. And I think I was a bit into it at some point. I wanted to get some of these pens. I remember back then in secondary school, one of my classmates got this fountain pen, and I started using it to write people's names in like very fashionistic. I will get paper or I'll use the back of my book, tear paper, and write their names like a very, very fancy way and put some flowers around it or something that's unique to their personality. And I'll sell it that time for 15 for 15 naira. Right. So I really wanted to expand on it. Like I wanted to get the pens. I remember that time I would check Jumia, but it was very, very cost. I'll beg my dad to help me get it. But that one went like that. So I still try my hands at it a bit now. I hope I can get like a tablet soon so that I can still explore more of what it is like. But that's very awesome. That's very awesome actually. Favor, do you also want us to guess your career?
Okay. Good evening,
Welcome to
everybody.
the career ladder. Yes. YG version.
Okay. ClickUp, Journal, and Google Workspace.
ClickUp, Journal, and Google Workspace. Project manager.
No.
Hey, Jesus. I start to thought the same thing because our project managers use ClickUp pass. Okay. Are you a writer?
No.
Hey, ClickUp. Oh, virtual assistant. Imo
Yeah.
says virtual assistant. Fuck it. So nobody else wants to guess. I shouldn't be the only one doing all the guesswork here. Okay. Esther has been engaging. Basira has been engaging. Okay, I think pretty much everybody here. Adedeji, are you here with us? Okay, Afimo, can you tell us about how you got into how you got into virtual assistant? Wait, no. Is it virtual assistant? Yeah. Can you tell us how you got into virtual assistant?
Okay. It, actually, it wasn't even something I planned. I think I just graduated about maybe 2 months after. I was opportune to apply for ALX course. I was very less busy then. Then I just applied for the virtual assistance course. And from there, I gained interest in it. I loved it so much. And I began to develop. But then after I got a while, I just went back to my closed doors. Just initially, I've always been this person that I love administrative work and all that. So I just do my thing back at the back. And fast forward to early this year, I just had that desire again, and boom, it just happened. I just reached out to somebody, oh, can I help you? Can I volunteer? And all of that. I spoke with the person, we got into a conversation. The person was like, oh, that's nice. That's nice. Okay, you can intern with me, and we move it all from there. And that was how we started. And right now, I I can say I love it. I am so into it. I have also applied for another course just to advance my knowledge in it. And yes, it has been a smooth ride ever since. So that's pretty much how I got into the virtual assistant.
All right. Thank you very much. Thank you very much, Pico. That's very nice. Okay, so I want us to just have a quick discussion, a very quick discussion. Because right now we started out, I think at some point on this call we're 30, right? And now we are barely, I think we're not even, I know we're not even up to 20. Does anybody know why? Can anybody like talk about or guess why people are less on this call? It's just like an open discussion. Okay, Basira, yeah, let's have you please.
Okay, good evening, everyone. Please confirm that you can hear me.
I can hear you. I can hear
All right. So I would say for tonight's session, it's a bit, it's not surface. So, and you know, the audience, you said most of the audience were students. So, students from different fields. So, most of the people would not be able to, like, you know, flow with the topic of today's discussion. And it was not surface stuff, it was deep. It might not be deep to the people that are in the finance world, but people that are outsiders, like layman like us, it's kind of deep. So, but if you still like give it your attention, I feel like you'll be able to get something. So I just feel that's why some people, like most of the people, left the call in between the session. Yeah.
All right. That's a nice theory. I want to hear what people has to say. Your hand is raised. Do you have anything to say about why people have left? Okay, I don't think Favor is with us. Or I don't think she meant to raise up her hand. Okay. Hi, well, I want to hear what you have to say.
Okay, so I agree with Fauzia, right? I think maybe because it was too complex for we that are like layman. But then when Fauzia asked her question, I actually got a lot of what the man was explaining later on when she asked her question.
All right.